People throw around this term PE ratio like it's the golden key to stock investing. And it could be, but most investors don't actually know how to use it properly, or worse, they think that a low PE always means a bargain. Nothing could be further from the truth. In this video, I'm going to break down what the PE ratio really tells you, how it can fool you, and how to use it the right way with real life stock examples that every investor should know. So let's first start off with, what is the PE ratio? Well, guys, it's very simple. PE equals price to earnings ratio. Now, what this means is the price of the company divided by the earnings of the company. So as an example, let's say to buy a company would cost you $10 per share, and the company makes $2 in earnings. The PE ratio is 5. Very simple. Price divided by earnings. Now, that's for per share. You can also use it as the price being the market cap divided by the total earnings of the company. Both are going to work themselves out the right way, because the market cap divided by the price per share is the number of shares outstanding, and the earnings divided by the number of shares outstanding is the earnings per share. Very simple, right? Absolutely. So let's bring up an exact example right now just to make it easy to understand. Let's pull up a company like Apple, and we're going to go here and say, okay, Apple's currently at $3 trillion in market cap divided by its net income of $97 billion. That is roughly 31 times PE, right? 3 divided by 97, 3 trillion divided by 97 billion. And look at here, 30.71. Very simple. Even simpler, let's go to our software. And what we do in our software is we go to the income statement, and over here in the format, we look at the annual number. In the last 12 months, the company has made $6.42 per share. Guess what, guys? The current share price is $198. 198 divided by 6.42 is 30.8, pretty much the exact same number. So that is how you can put both of those together. It's a very simple rate. It's basically saying to you, how much are you paying for every dollar of earnings? Okay. Now, it's great for comparison. You can sit there and look at two companies in industry, the exact same companies, and say, okay, this one's selling for this PE, this one's selling for this PE. Which one's a better deal? Well, there's more to it than just that. That's the big key here. The common misconception is that a low PE means that the company's undervalued, and a high PE means that it's overpriced. Well, first off, the question should be, what's low and what's high? Well, the historical average is around 15 or 16. So the average company will sell for between 15 and 16 times its earnings. So if a company makes $10 per share, it should sell for between $150 and $160 per share. $10 per share times 15 or 16. Now, here's where it gets tricky. Let me ask you guys a question here. Let's say there are two companies, and they're the exact same company, okay? Company A makes $10 per share. Company B makes $10 per share. Everything else is the same. I'm doing this for simplicity reason. Now, let's say this company can grow its earnings at 20% per year, and this company can grow its earnings at 5% per year. So, at this pace, every 3.5 years, the company's profit's going to double. At this pace, every 17 years, the company's profit's going to double. Which one should sell for a higher premium? If they're both selling for 15 times earnings, so this one sells for $150 and this one sells for $150, which one's the better investment? Guys, everything being equal, by far this one. Because you know why? In the next 10 years, this company's going to go from $10 in profit. It's going to double 3 times. That makes $80 per share in profit. In the next 10 years, this company's going to go to roughly $16 per share in profit. That's why this deserves a premium. That's why you can't just look at PE and say a low PE means a better price. In fact, if this company were selling for $100, 10 times its profit, I would still rather own this one. So 10 PE versus 15, and this is still the better investment. Because at 10 times profit, even at 15 times profit, on the $16 profit share, Profit number per share, you're looking at $240 per share, give or take. At this one, at 15, you're at $1,200 in a share price. Would you rather pay $150 to get $1,200 or pay $100 to get $240? Of course, you'd rather do this. That's the big thing that I missed for a long time as well as an investor. I missed this over and over, that you should pay a premium for a better quality business that can grow its revenue and profit faster. Now, guys, an example I always give, and people sometimes sit there and go, Paul, you talk about this nonstop. I do, because it was Microsoft and it was incredible. Microsoft 15 years ago. Let's go pull up Microsoft's data 15 years ago. Let's go back to 2010. Microsoft was making $18.7 billion per year, $2 per share. $2 per share here. Let's just round down to $2 a share. At a 15 times PE, it should have been selling for $30 a share. Guess what it was selling for at the end, in the middle of 2010? Well, we're gonna go to our pricing here. Max, middle of 2010, this stock was selling for $23 per share. And it was making $2.13 per share. It was selling at one point, actually, I remember selling for 8 or 9 times earnings. The PE was 8 or 9. Now, we look at Microsoft today, it's selling for 37 times earnings. And Microsoft's an incredible company, but what drove it down to 8 or 9 times earnings? Perception. It was still growing 7-8% a year in revenue, and its profit was growing 10 to 12%. But people didn't like the fact that Microsoft stock 10 years before was at 55 and had fallen all the way down at some point $11 or $12 per share. And people said the company was dead. Was the company dead? Or was the stock so low that news followed the stock price and people felt the company was dead? But Microsoft was still growing very steadily, and its profit was growing well because they had a high gross margin and high returns on capital. This was a massive mispricing. And this happens all the time. Look at Apple. Apple was doing the same thing as recently as 10 or 12 years ago. They were selling for 10 to 15 times earnings, and their revenue was growing like crazy. The difference there was people were wondering, and this is my mistake, is the iPhone here to stay? Or is it just technology where it ebbs and flows? You've got to be able to look at these companies and say, okay, which companies are great, which companies are bad. But what makes them great or bad is going to dictate the PE you should pay. And it's not based on the current perception in the market. It's based on reality. But the thing is, we don't know the future. The future is unknown. This is why we need that margin of safety. But when the future is unknown, it's hard to really determine what is right or wrong. Look at NVIDIA. NVIDIA is a great example because NVIDIA's profit and revenue skyrocketed in the last few years, and nobody saw that coming. It was from AI. Look at this. Let's go before 2020. 5 billion, 7 billion, 9.7, 11.7, 10.9. So during COVID, it kind of fell a little bit. But that's the point here. It was consistently growing. And then look at this. 16.7, 27, 27, 61, 130, $148 billion in revenue. It's 15 times more revenue than 2020. Nobody saw that coming. If we knew the future, you absolutely were going to buy that company because look what it was selling for in 2020. In 2020, it was selling for $9 a share. It's up 1,500% since 2020. And guess what the PE was back then? That's the interesting part. Let's go look at that PE. We're going to go to the financials, go to the income statement. In 2020, it was making 12 cents per share, and it was selling for $10. Guys, what's that PE? It's like 100. It's an absurd PE. So high. It's like 80. That doesn't make any sense. Why would you buy that company? You'd buy it if you knew what the future held. But we don't know what the future holds, and not every company is going to be like NVIDIA. In fact, no company is going to be like NVIDIA. Now, we use the PE ratio in everything we look at. In our stock analyzer tool, we use it as our multiple for the future because you have to sit there and decide, okay, what's this company worth at some point? Now, guys, as you know, I use my 8 pillars as a way of looking at a company and understanding a story. And the very first metric is the 5-year PE. Now, I don't look at a 1-year PE because any given year, there can be one-time costs, one-time revenue jumps that are awesome. I don't want to value that. I want to look at it from a 5-year perspective. So I look at that saying, hey, I'm going to give a premium to that historical number. I'm going to go to 22.5. And I don't even know that's the right thing. In fact, if you watch our videos, I will say, hey, there's X's here. But does that mean they're expensive? We don't know. What does the future hold for that company? If God came down right now and said, Paul, Microsoft's going to grow its profit at 50% a year for the next 20 years, I'm buying it all day today. If God came down and said, Paul, they're going to grow it at 4% a year for the next 20 years, I'm going to say, this is massively overpriced. The same company, the same current profit, the same history, the same PE, 2 different growth rates, 2 different values. That's what's so key here. That's why all of these pillars in here have a certain thing to understand. That it's not just a snapshot of what this is, it's how it plays a role in the company's future and current pricing. Now, if you want to understand all these other pillars more, click the link below. We will email you a free PDF explaining all 8 of these pillars and how you should think about them. It'll be in your inbox in just a few minutes. Just click that link below. It'll be there. Now, guys, this is why you hear Charlie Munger and Warren Buffett say that a top quality company that has high returns on capital, which allows them to invest money in the business and grow their profit at a faster level, might appear, based on some metrics, to be expensive, but they're actually cheap. That is what they're talking about here. The PE might be very high, but relative to their growth rate, it's not. In fact, there's a metric out there that Peter Lynch loves called the price to earnings ratio with growth, the PEG ratio. It takes the price to earnings ratio divided by a growth rate and gives you some sort of metric. I don't really look at that much because I have our stock analyzer tool. And in our stock analyzer tool, the very first line is revenue growth. Because I want to sit there and say, listen, a top quality company that can grow its revenue and profit at a faster rate deserves a premium. That's super, super important to understand. Now, if you've made it this far, you're serious about understanding how investing works. I want you to watch our latest video linked on the screen to see us marry the PE with all 8 pillars and see how we analyze a stock. Thank you for your time.